Welcome to RBC's Markets in Motion podcast, recorded November 11th, 2024. I'm Lori Calvasina, Head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. 3 big things you need to know. First, earnings season is winding down with a disappointing feel to us on the stats, though admittedly, it's just not driving the price action right now. Second, in our transcript reading, a mixed macro and consumer remains in focus as companies begin to highlight key policy issues they're watching post-election. And third, positioning in U.S. equity futures for both the S&P 500 and Russell 2000 looks stretched. Valuations have some room to run, but not a ton. If you'd like to hear more, here's another 5 minutes. Starting with takeaway number 1. Earnings season is winding down with a disappointing feel. Not that anyone's really paying attention right now. Here's what jumps out to us on the stats. Within the S&P 500, the percent of companies beating consensus EPS forecasts, 72%, is still a little below 2Q24 levels, though revenue beats are in line with the previous quarter. Within the Russell 1000, companies beating consensus earnings forecasts continue to show underperformance versus the broader market in terms of their immediate stock price reaction. This remains a broad-based trend by sector. Earnings sentiment overall does remain negative, with the 4-week average of the rate of upward EPS estimate revisions in the S&P 500 to current year and next year consensus forecasts tracking at 46%, meaning slightly more downward than upward revisions. Trends remain similar in the Russell 2000. Moving on to takeaway number 2. A mixed macro and consumer remain in focus as companies begin to highlight key policy issues they're watching post-election. In our earnings transcript reading, there were no major changes in themes discussed this past week beyond the ones we've been highlighting. Discussions of the macro outlook and demand remained mixed, as did discussions of the state of the consumer. The Fed, interest rates, inflation, and cost did seem less in focus than what we've been observing the last few weeks. Geographical discussions continue to highlight weakness in China, with some references to optimism around recent stimulus announcements. Companies continue to highlight AI successes around and strategic considerations around technology, but some example of early AI wins did frankly remain underwhelming. The U.S. election was in the middle of the week, and it's just too early to detect a clear shift in tone or a shift in corporate behavior due to the event. Companies that reported after the election did highlight uncertainty over tariff policy and optimism over less focus on things like drug prices and easing regulatory burdens. Others noted they were monitoring the House outcome, tax policy, and the M&A approval process. Wrapping up with what else jumps out to us right now. Positioning and sentiment in U.S. equities does look a bit stretched. U.S. equity positioning in the futures market, including S&P 500 contracts, was at an all-time high on Election Day per CFTC's Friday update. Russell 2000 futures positioning was also close to past peaks, which were achieved in 2016, 2017, and 2018 after a series of political-related trades into small caps on election optimism, tax reform, and the China trade war. Investors have been asking us whether small caps have more room to run, but we're starting to wonder if this just isn't the right question, as small caps did experience several short-term outperformance trades during Trump's first term. More frequent leadership shifts may just be something investors need to get ready for in the years ahead. It's worth noting that U.S. equities also look a little bit stretched from a valuation perspective. We're keeping a close eye on the S&P 500 equal weight forward PE, which has moved up to 19 times, well above average but not quite back to past peaks. The same is true for the S&P 500 median PE excluding the top 10 market cap names, which is a little lower at 18.7. The Russell 2000 has also lost some of its valuation appeal after last week's post-election surge. At 17.8 times, the Russell 2000 market cap weighted PE is now within the range of PEs that were seen during the first Trump presidency. Those, for reference, were 18.9 times in 2016, 19.7 times in 2017, and 17.6 times in 2018. Overall, we just can't quite say that valuations have peaked on either the S&P or Russell, but what we do know is that there's far less room to expand going forward. Taking a step back from all the data, it's difficult to pinpoint what might spark a pullback in U.S. equities in terms of narrative right now. A surprise comeback for Democrats in the House is one very low probability tail risk we're monitoring. Geopolitics, as always, is another. But we do remain mindful that there's not much capacity to absorb disappointing news right now. Election uncertainty has dissipated, and U.S. equities are feeling optimistic over the direction of government policy, though it is also fair to say that policy uncertainty itself remains, and we continue to worry that corporate tax plans in particular might not provide the big boost to earnings that markets expect right now. For now, the equity market seems to be in a discovery process regarding the new administration's domestic economic policy in terms of what the priorities will be and what the contours of the plans will be. Overall, what we do know is that we need to be getting ready for a more dynamic backdrop, which simply requires more nimbleness in trading in the year ahead. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.